SpaceX is public, but the bigger index trade comes next. Hi, this is Ian from Global Market Edge. SpaceX is now public. The IPO is done. The stock is trading. And the first wave of excitement has already played out. The shares were priced at $135 for the IPO. They opened around $150. They ran hard in the first few sessions. They traded above $220, then pulled back. And now the market is trying to figure out what SpaceX is actually worth as a listed company. That is normal. Big IPOs often have a first wave of excitement. There's the headline, there's the retail demand, there's the media coverage, there's the Elon Musk factor, there's the scarcity of share, and there are traders trying to get in front of the next move. But for me, the more important story is not just the IPO. The more important story is what happens after the IPO. Because in modern markets, it's not just about whether people like a company. It's about where that company sits inside the market structure. And one of the most powerful forces in modern markets is index buying. That is the real story with SpaceX now. The IPO was stage 1, the Russell inclusion was stage 2, the Nasdaq inclusion we'll call stage 3, and the big one eventually is the S&P 500. That is where the deepest pool of passive capital sits. That is where the large index funds, ETFs, pensions, retirement accounts, and institutional benchmarks matter. So when I look at SpaceX now, I'm not just asking whether the stock is expensive or cheap today. I'm asking a different question. Where is the future demand going to come from? SpaceX is one of the most important companies in the world. It is involved in rockets, satellites, Starlink, launch infrastructure, space-based communications, and potentially a much broader technology ecosystem over time. So it was always going to attract attention once it became public, but attention and index demands are not the same thing. Retail traders can buy because they like the story. Institutions can buy because they like the company. Momentum traders can buy because the stock is moving. But index funds buy for a different reason. They buy because the index changes. That is forced buying. And that is what a lot of traders underestimate. A company can be popular, a company can be huge, a company can dominate the headline, but the real structural demand starts when it enters the major indexes. That is why Russell inclusion matters. That is why the Nasdaq 100 inclusion matters. And that is why the S&P 500 matters most of all. Now, this does not mean SpaceX automatically goes straight into the S&P 500. That is an important point. The S&P 500 is not just a list of the biggest companies in America. It is a curated index. A company needs size, it needs liquidity, it needs public float, it needs financial viability, it needs earnings eligibility, and it needs to be accepted by the index committee. So a company can be enormous and still not automatically enter the S&P 500 immediately. That distinction matters. SpaceX is already public, but public listing is one thing. S&P 500 inclusion is another thing. And that is where the market structure gets interesting. Because once a company enters the S&P 500, that flow impact can be massive. Why? Because trillions of dollars track the S&P 500. Index funds track it. ETFs track it. Pension funds benchmark against it. Asset managers use it. Retirement accounts use it. And passive investors all over the world are constantly allocating more and more capital to products that follow that index. So when a new company gets added, those funds need exposure. They do not buy because they suddenly discovered the story. They buy because the index changed. That is the power of forced buying. But there is another side to this story. Forced buying does not mean risk disappears. It does not mean the stock goes up forever. It does not mean valuation no longer matters. And it does not mean you should chase every index headline. A lot of these moves get anticipated before the actual inclusion happens. Traders front run the flow, institutions prepare early, the stock can rally before the event. And then when the actual inclusion happens, some people sell into the demand, which is where the old market saying comes from: buy the rumor, sell the news. So there is always a buy side and a sell side. That is the key point. Markets are not just about demand, they are about supply and demand. Even when index funds have to buy, there can still be selling from early investors, institutions, insiders, funds, or traders taking profit. That is why you still have to respect price. You still have to respect valuation, and you still have to respect liquidity. And you still have to understand who may be selling into the demand. But the reason index inclusion matters is because it creates a structural buyer, and structural buyers are powerful. That is why SpaceX is such an important case study. It is not just another IPO. It is a test case for how massive new public companies get absorbed into modern market structure. First, the IPO brings in the market. Then Russell inclusion brings in passive index buying. Then Nasdaq 100 inclusion brings in another layer of passive demand. And eventually, if SpaceX meets the requirements, the S&P 500 becomes the biggest structural event. That is the big daddy, because the S&P 500 is not just an index. It is one of the biggest liquidity machines in the world. Every month, money flows into retirement accounts, pension funds, managed portfolios, ETFs, and passive products. A lot of that money ends up in the S&P 500. That creates a consistent, long-term bid under the highest quality, most liquid part of the US equity market. This is also why the S&P 500 is different from something like the Russell 2000. The Russell 2000 gives you exposure to smaller companies. Some of those companies can do very well, but as a group, they do not have the same quality portfolio, liquidity portfolio, profitability portfolio, or global institutional demand as the S&P 500. The Nasdaq is different again. The Nasdaq gives you strong exposure to technology and growth, but it is more concentrated. It can be more sensitive to interest rates, duration, AI sentiment, and high growth positioning. The S&P 500 sits in the middle of the global equity system. It has technology, it has healthcare, it has financials, it has industrials, it has consumer companies, it has energy. It has the largest and most liquid companies in the US market. And because of that, it attracts global capital. That is why, for long-term passive exposure, I think the cleanest bias is usually towards the S&P 500. Not because it goes up every day, it does not. Not because it cannot crash, it can. Not because valuation doesn't matter. Valuation always matters. But because the structure of the market keeps pushing capital towards the largest, most liquid, most profitable companies. And the index has a built-in discipline. Companies that grow, become profitable, become liquid, and become institutionally important can eventually enter. Companies that shrink, weaken, or lose relevance can eventually leave. So over time, the index naturally rotates towards the winners and away from the losers. This is a very powerful structure. And this is the bigger lesson from SpaceX. Most people are going to look at the stock and argue about whether it's worth 150 or 180 or 220 or something else. That debate matters, but it is not the only debate. The bigger question is, how does this company get absorbed into the global passive investment machine? That is where the flow comes from. That is where the liquidity comes from. That is where the forced buying comes from. And that is where the long-term structural demand can come from if the company eventually becomes eligible for the S&P 500. So for traders, SpaceX is not just a story stock. It is a flow stock. The IPO created the first trade. The Russell inclusion created another flow event. The Nasdaq inclusion creates another one. And the S&P 500, if it eventually happens, would be the biggest structural event of all. But you still have to be careful. A great company can still be an expensive stock. A powerful story can still become overcrowded. And forced buying can still be met by forced selling, profit-taking, insider supply, or valuation discipline. So the right way to think about SpaceX is not, will it go up forever? The better question is, where is the next major pool of demand coming from? This is how professional markets think. They look at the story, but they also look at the flow. They ask, who owns it? Who needs to buy it? Who is benchmarked to it? Who is underweight? Who is forced to add it? And who may use the demand to sell? That is the market structure behind the headline. So the takeaway is this: SpaceX is already public. The IPO trade has already started. The stock has already had its first big move. But the bigger structural story is still developing. Russell inclusion matters, Nasdaq inclusion matters, and eventually S&P 500 eligibility is the big one. Because in modern markets, the story matters, but the flow often matters more. This is Ian from Global Market Edge. This content is for general education only and is not financial advice.